Hey everyone, welcome back to Corporate Decoder, the place where we sift through corporate filings so you don't have to. Today we're diving into ACCO Brand's latest 10K report, and let me tell you, it's a mixed bag. Think of it like this: you're expecting a party, but half the guests don't show and the DJ only plays sad songs, but the snacks are surprisingly good. We'll unwrap the details behind their sales dip, unexpected losses, and some cost-cutting moves that might just save the day. ACCO Brands, if you don't know, is a global company selling all sorts of consumer, tech, and office products. Think brands like 5 Star, Mead, Kensington, and Powerade. They're sold in schools, homes, and workplaces everywhere. So, what's been going on with them lately? Well, their annual report says it all. We are looking at the report for the fiscal year ended December 31st, 2024. It's like a yearly health check for the company, and it gives us a good picture of where they stand. Were they in great shape, or did they have a few bruises? Let's find out. First things first, the company is organized into two main operating segments. It's helpful to keep in mind throughout this analysis. There's the Americas, covering the United States, Canada, and Latin America. Then there's International, which includes Europe, the Middle East, Africa, and the Asia Pacific region. It basically splits the world in half. Here's where things get interesting because ACCO Brands sales tend to change with the seasons. The first quarter is usually their slowest, with sales and profits lower than the rest of the year. That happens because the back-to-school shopping season in the US, which is a huge deal for them, mostly falls in the second and third quarters. So how did they actually perform? In 2024, sales dropped by about 9%. That's almost $200 million less than the previous year. A big reason, people just weren't spending as much on certain office-related stuff. They also got out of some lower profit businesses and had fewer back-to-school purchases. But it wasn't all bad. Sales in gaming accessories actually went up, so gaming seems to be one of the few bright spots. However, gross profit, which is the profit after you take away the cost of making and selling the products, was also down. That happened even though they managed to cut costs in other areas. Luckily, they still managed to expand the gross profit margin a little. Now, here is a big hit. They had an operating loss of $37 million. That's not good, and it's a big change from the previous year when they had an operating income of almost $45 million. What happened? It's mainly because they had to write down the value of some of their assets. These are known as impairment charges, and they don't involve actual cash, but they really hurt the books. All that bad news led to a net loss of over $100 million, which translated to a loss of $1.06 per share. That's a pretty rough year. However, not all is gloomy. They generated some positive cash. Now let's take a look at the differences between their two segments, the Americas and International. What's going on in different parts of the world? The Americas took a bigger hit. Sales were down by 12%, largely due to lower demand for school and office products. In turn, they took a large loss. Internationally, things were a little better. Sales only dropped about 4%. Even better, their profit actually increased a little thanks to cost cuts and price increases. So, what is the money situation? They need cash to keep things running, pay off debts, invest in the company, and give dividends to stockholders. Their main sources of cash are what they earn from sales, the cash they already have, and borrowing money when needed. At the end of 2024, they had about $74 million in cash on hand and over $300 million available to borrow. But their borrowing agreements come with rules called covenants that limit what they can do with their money. For example, there are limits on how much new debt they can take on and how much they can spend on dividends or buying back their own stock. It's like having a credit card with a lot of conditions. To try to get back on track, ACCO Brands has announced a plan to cut costs. They are aiming to save at least $60 million a year by simplifying their operations and reducing their workforce. They even raised their savings target to $100 million. Will it be enough? Only time will tell. Also important to note, as a global company, they face risks from changing currency values. When the US dollar gets stronger, it makes their products more expensive in other countries, which can hurt sales. To deal with this, they use financial tools called hedges. Cybersecurity is also an important factor that the company looks out for. They realize that their business depends on technology and data. They use security to keep their data safe from attacks. Okay, so what's our take on ACCO brands? Their year was challenging, no doubt. Sales declines and a big net loss make it obvious. There are some strong brands and a new cost-cutting plan, which is a positive sign. However, they face some big risks. Customer concentration, meaning they rely heavily on a few big clients, and fluctuations in foreign exchange rates. A major recession could also hurt since folks could reduce the amount they spend on products. There's a long way before they can be sure of a steady recovery. From a valuation perspective, the company is a tough one to pinpoint at the moment. While their consistent operating cash flow is a big plus, the recent unprofitability makes valuing them difficult. It trades at roughly 8 times its 2024 operating cash flow, which can be considered low. However, with the recent reorganization and savings, the future performance will be the real decider. So where does this leave us? It's a tough call. The cost-cutting plan could improve things. However, some big risks and market dynamics persist. Based on everything, I'm leaning slightly bearish at the moment. I would expect the stock to trade in the $4 to $5 range. That's it for today's Corporate Decoder. If you enjoyed this deep dive, please subscribe for more simplified breakdowns of complex company reports. Thanks for watching.